Okay, good evening, ladies and gents. Tonight is our first session for the week. Today is the 28th of the first month, 2020. And for the guys who are new, welcome, right, to new to the advanced session, one. And the guys who are more like old school guys, if you can call you that. But the guys who've been in one or two of the previous sessions, I'm welcoming you back as well. Okay. Now, I think the most important thing. Okay, I trust that everyone can hear me. Now, the most important thing is we need to get a few things out the way, obviously, before we start off our session. The first one being the basic housekeeping rules. If you have a question, type your question, and I'll repeat the question again, and then you'll be able to answer. Then I'll proceed basically to answer whatever question that you might have. Or secondly, what you can do is you can raise your hand, click the raise your hand button. I will unmute your mic. You'll be able to speak, and then we'll be able to have sort of like a conversation during the session. And I'll proceed to answer as best I can whatever question that you might have. Okay. And those are the basic housekeeping rules. Now, hopefully you guys will be following them accordingly, just to make sure that whatever questions that you do have will get responded to. And secondly, we've been speaking quite recently regarding signals, right? A lot of guys who have been in the signal group for quite some time. I think at most about 4 months or so. And there's a bunch of queries and questions regarding how the signals group is actually structured, and it has been free ever since we created it, and no one has been paying anything for it. However, now I feel like it's time for us to convert that, because it's a lot of admin, because now I need to check if this guy really funded with the right account size and follow the link that I actually provided, and it's getting to a point where it's a bit of a headache. Now, the only thing that's going to happen now, you can fund with any broker, any size account, as long as you have the minimum. You can show me that you have the minimum size account, okay, either via a screenshot or photo, whatever the case may be. At least I'll be able to have an idea how much you have in your account. Okay, we don't want to have a situation where guys take trading signals with too low account funds, right, capital, and then get into a situation where they margin out their accounts, and then it becomes an issue. So to avoid all of that, that's what we're going to do. Right, I'll post everything in the Telegram channel. I'll send through the link for the questions. Anyone who has questions regarding the trading signals, right, they can do that. But with copycat trading, that is still free, as long as provided you can fund the minimum account balance, right? Obviously, we need to use the same broker, because it's sort of like a PAM account type of thing, and you need to use the exact same broker. I need to create an offer. I need to create an offer. Then you need to link up to that offer in order for you to link your trading account with our trading account. So it has to be with the same broker. Okay. So all details will be posted on the Telegram channel. Just thought I should get that out the way. I don't think I've ever spoken about that during one of the sessions. So hopefully this will clear up a lot of the confusion that might be apparent. Okay. Now, today we're just going to be looking at one of my favorite, okay, if I can call it that, one of my favorite tools that we can use in order for us to determine the directional bias of a particular market. Okay, one of these tools, second favorite basically, is the Fibonacci, right? We've done the Fibonacci quite extensively, and in essence, we've managed to understand its use, its practice, and also understand how we can then apply it, okay, to sort of like the markets and exits as well as entries. Okay, so those are the two things we've been able to do, right? We've been able to identify how to enter a market and also how to exit a market using this quite useful tool called the Fibonacci retracement tool. Okay. Now, aside from that, right, as I said, that's my second favorite tool. my first one is something that's a bit basic, something that's a bit, I mean, a lot of guys like to think some esoteric indicator oscillator would be something that a trader would value, okay? But it's something that's sort of like widely regarded as one of the fundamental tools or methodologies that people use to decipher the markets, and that is basic support and resistance. Okay. Now, for the past, I think, 3 sessions, we've been looking at support and resistance in a way that, okay, all right, let me do this. Okay, we've looked at basic support and resistance, and what we did is we didn't have any of these big figures or round numbers when we were looking at them. So we were just looking at sort of like the raw chart, just with basic support and resistance levels on the higher time frames. But now what we can do is, in order for us to sort of like have a sort of like a well-rounded support or resistance level, we also use these psychological support and resistance levels. Okay, if you're not quite familiar with how these work, you can look in the PDF or the ebook. All the tools that we actually use in strategy 1 are entailed in the ebook. Just go through that. You should actually have it open up somewhere, so when we're going through all of this, you can just sort of like refer, because this is going to be more the practical side of things, and the theoretical side of things about how and why we use certain indicators, oscillators, and candlestick patterns will then be explained in much more detail in that particular ebook. Okay. All right. So I think what's more important is everyone should just send through a message. Okay, I think you should send a message via Telegram, or I'll send through the link for that WhatsApp there, and then you guys can just send a message there with your email address. I'll have this indicator emailed through to you, okay, along with instructions on how you can just basically install it onto your template. Okay, now we're looking at the GBP JPY on the daily time frame, and as you can see, it does look like it has been on a upward trajectory for quite a few days or so, right? Well, rather a few months. Okay, this is 1 month, 2, 3, 4, 5. Okay, now as the old adage goes, or sort of like the old conventional way of thinking about the markets, is that the markets will basically range much more or for much longer periods of time, rather, as opposed to trending. So if a market is going to move sideways, it's going to move sideways more often than it does in one particular direction. Right? So we might have a ranging market like we did for about a month and a half, probably about a month and a half, or like a month and a quarter. And you can see that the market moved sideways for that particular amount of time, and all of a sudden you got one push to the upside, the market pulled back inside into this range, and then proceeded to move sideways a bit. Okay, as you can see right now, we're actually in a sideways ranging market on the GBP JPY on the daily time frame. But what we can do, or what we can see, is the basic support and resistance levels. Okay, now we have a low over here. Okay, let's change this to a yellow color, right? Because I don't think the dark blue is going to do us any justice. Right, let's use a yellow, right, and make it nice and thick. You can see the bounce off that 140, okay, 141 zone, right? Let's just put it there on 141 exactly. Okay, my arm is shaking quite a bit, guys. Apologies. Actually, just came out a hectic session in the gym, so I think that's why. The market moves away from that 141 zone, back into that 141, breaks above the 141, retests the 141, and comes back to retest it once, twice, and you can say 3 times, and moves away from that 141. And you can see that the market was about 50 pips away from that 141 zone. Okay, Now, the nice thing about this zone, this 141 zone, is that there is a psychological support and resistance, which is within the round numbers, and a technical support and resistance, which is obviously visible with the eye, right? It's something that we can see because the market has retraced at this point, broke above, and then rejected again, okay? All right. Okay, so as you can see, the market is close to that 141 zone. And what we'd like to see from that particular area is either a bounce off that 141 rejection back into the range, because the market is still ranging technically, or a break below this 141, retrace back into that 141 zone, and then move to the downside. So typically, typically what we'd like to see is one of these two sort of like scenarios. Okay, a break below this 141.100, retrace back in and to the downside, or reject, retrace, boom, upside. All right, now with these two contradicting sort of like biases, a lot of people will be looking to say, okay, what would be the more I can say conservative, or the more, or the safer approach, or the one that's, or some people will actually ask the reverse side of things and it's like, okay, what would be the one that's going to make me the most amount of money? Because with the way that humans think, right, humans will always tend to think, okay, well, can't quite certain with the words always, right, but up until now, people have always associated, traders have always associated being right a lot with making a lot of money. Meaning, if I am right 90% of the time, that means I must be making a killing. And if I'm right 99% of the time, that means I must be making a killing. Right? Of which, obviously, if you know anything about trading and about probability and all this other stuff, you recognize that it doesn't really mean much when you're winning 90% of the time, right? And the 1 or 99% of the time, or that, and then that 1% of the time you do lose, you clean out your account, right? You don't have anything left to trade with. So obviously you need to make a trade-off between winning a lot, okay, and winning big, but not winning as many positions or trades that you would normally if you just adopted a way that was focused purely on just winning more often than not. Okay, because you can make 50, you can win 50% of your trades, but if those 50% of your trades that you do win bank you $1,000, and the 50% that you do lose only $100, I mean, one of the richest people in Babylon. Okay, so if that is obviously going to be the approach, then a breakout methodology will always work for you, as long as you stick to the guidelines. Okay, now a lot of questions will come through about, right, can't I just place a buy stop right there, place a stop loss over there, and just see if the market is going to bounce off, and then if it breaks below and comes back up, then I'll place a sell stop and then it drops down to my direction. I mean, you can always think in those scenarios, but if you do place, let's say, a buy stop somewhere around here, so if you place your buy stop at 141, because let's say you're working or something, so you can't wait to see if the market will reject around that area, then the only present issue, or the only real issue that you might have there, is the market drops down aggressively, closes below that zone, okay, and does this instead, okay, pulls back into that zone, right, and doesn't really come back to that area to actually get you out. Because a lot of guys will take a position, right? They will take that buy at 140-100, and if the market reaches 140-100 and extends and they're down 40, 50, 60 pips, what they do is they'll hang on to that losing position until the market comes back to that 141 zone. Okay, guys are with me. So that's the one common mistake that a lot of people will actually make. And sometimes the market will come back, right? And sort of like release you from that drawdown. Sometimes it will just come back close to that 141 zone, and all of a sudden you see the market, fall apart and don't really catch you out. So you might be down 60 pips when the market is here. So let's just say $60, and the market retraces quite a bit. Okay, and the market, let's say, let me clear that up, and it sort of like looks like it's heading upwards, and then all of a sudden it collapses to the downside, and at most you were down about -$6, and now the market has dropped about 100 pips or 150 pips. Now you're down 150 US dollars against your position, and obviously the larger the loss gets, the more difficult it is to cut it. But that's something for another day. But what you should be focusing on at this present moment, right, is when you're looking at that psychological support and resistance level, okay, you're sort of like looking at it as where the big players will be coming in or getting out. Because a lot of institutions will obviously use these psychological support and resistance levels, these 130, these 13,700 zones, right, in the USD ZAR. Okay, I'm not sure if there is a USD ZAR over here. Okay, as you guys can tell, I'm not a huge USD ZAR fan. I doubt this has a USD ZAR, so because I just like using the United States dollar and the South African rand, because it sort of like clears things up and helps people relate to whatever I'm explaining a bit more, I guess. So in the USD ZAR, for example, it would be 13 Rand, let's say 50, or 15 Rand, or 14 Rand 50, whatever the case may be. And that basically means that if you're looking at the market from that angle, so if you're looking at the market from the perspective that it's at 13 Rand 50, okay, a lot of eyes will be on the market around that price. Okay, if the United States dollar and the South African rand rises to 17 Rand 70, okay, most likely most sellers will want to come in at 18 Rand, right? That 30-cent difference, right? They won't want to be short at 17 Rand 70. A lot of sellers will come in, I'm not saying most, a lot will want to come in when the price reaches 18 Rand, because that's when sort of like the peak interest actually comes in. And when it's low, for example, if it drops down to 10 Rand 34, okay, so it's 10 Rand 34, not a lot of people will be as interested in that market as if it drops down to exactly 10 Rand. So when it's exactly 10 Rand, they're going to be like, nope, this looks a bit undervalued. Or 9 Rand 99, the United States is undervalued against the South African rand. Hence, we're looking to get long on the dollar and short on the rand. Okay. All right, guys. Any questions so far? Okay, no questions. All right, let me clear this up again. All right, we got a few minutes left, so I'll just try to wrap up so we can start the second session with the other guys. All right, so let me grab this tool. In this instance now, so practically speaking. So if we're looking at the GBP JPY in the daily time frame, and we're looking at a clean chart, right? We're just looking at a clean chart or a chart like this, whatever the case may be, and we're trying to come to a decision about whether we should buy or we should sell, or if we should get into the market, right? So we're just shooting all the time. We just want to see what we should be doing, but nothing really comes to mind. The very first thing that you should be doing is obviously looking at those major daily support and resistance levels. Once you can get aligned with the basic support and resistance levels, I mean, from there you can then start to sort of like build your case about whether to get into the market or to stay out, whether it's a high probability trade setup or not. Because at this point, you can see we were about 50 pips, now we're about 100 pips from a very good support level, right? Was a previous resistance because market broke above it a few times, well, broke above it once and came back to retest. So most likely what we'd see is a retracement, because more often than not, the market will range than it will trend in one particular direction. So there's a high probability that the market will come in, reject at that 141 zone. But if it does happen, because I mean, no one really does have a crystal ball and can tell you with 100% certainty how the markets will. Okay, apologies guys. Don't know what happened there. Okay. So we're looking at so if then, because we don't know with 100% certainty, we need to let the market develop, right? Let the market break below that support structure and come back as resistance, right? And reject on that resistance, because the market can do this and then it go back up again, and then it goes like this, and then only tags that resistance, okay, and then moves in your direction. Okay, nothing is stopping the market from actually doing that, which is, I think, something that happens somewhere with these markets. But it shouldn't be something of great concern for you if the market does this, as long as you then follow the guidelines for identifying how to verify if a trade really is a high probability trade setup or if it's just garbage in a sense. Okay. All right, you guys are with me. Okay. All right, guys. So if you guys don't have any questions, I'll be ending off tonight's session here. And tomorrow we're having our normal beginner session. It's going to start at 7 p.m. Right? There's a bit more stuff that I might include in tomorrow's advanced session. So make sure that you do make time to attend that. Okay, so I think I've clarified everything regarding signals and all that other stuff. So I don't think I'll be going over that tomorrow. But what's important is follow the link, right? It'll take you straight through to the WhatsApp group, right, or to the WhatsApp chat rather, and you can either leave your emails to get sent the indicator as well as the instructions on how to install it, or you can just pick it up from the group or from the Telegram channel. I'm not quite certain where that is, but I will definitely see where it is. I'll probably just try and tag it and put it somewhere lower in the Telegram channel. Okay. All right, guys. If there's nothing else, I'll be ending off tonight's session here. Thank you very much for coming through, and I will see you guys tomorrow at 7 p.m. for our beginner session. Enjoy your evening, guys. Cheers.